After studying this module, you shall be able to know about the structure of interest rates, understand the concept of yield maturity, understand the Fisher effect, know about the factors affecting interest rates. Introduction: interest rate level, maturity and structure of interest rate. Interest rate is the cost of borrowing money. Therefore, it is the price paid by the borrower or debtor for using the resources money of a lender or creditor. It is usually expressed as percentage of total amount borrowed. The policies and the performance of all the financial institutions are impacted by the movement in the interest rates. This fact underlines the significance of underlying interest rate movements through the factors having a significant influence on its movements. Two important theories influence the determination of interest rate: Fisher theory underlying the loanable funds theory and liquidity preference theory of Keynes. Structure of interest rates. The term structure of interest rate is the relationship between interest rates or bond yields and different terms of maturities. The term structure of interest rate is also known as a yield curve, and it plays a central role in an economy. The term structure reflects expectations of money participants about future changes in interest rates and their assessment of monetary policy. Term structure of interest rate is the variation of yield of bonds with similar risk profile with the terms of those bonds. The yield curve is the relationship of the yield to maturity (YTM) of bonds to the time to maturity, or more accurately to duration, which is sometimes referred to as the effective maturity. In most cases, bonds with longer maturities have higher yields. However, sometimes the yield curve becomes inverted, with short-term notes and bonds having higher yields than long-term bonds. Sometimes the yield curve may even be flat, where the yield is same regardless of the maturity. The actual shape of the yield curve depends on economic condition, fiscal policies, expected forward rates, inflation, foreign exchange rates, foreign capital inflows and outflows, credit rating of bonds, tax policies, and the current state of the economy. The term structure of interest rate has three characteristics. The change in yield of different term bonds tends to move in the same direction. The yield of short-term bonds are more volatile than long-term bonds. The yield on long-term bonds tend to be higher than short-term bonds. The expectation hypothesis has been advanced to explain the first two characteristics, and the premium liquidity theory have been advanced to explain the last characteristic. The market segmentation theory explains the yield curve in terms of supply and demand within the individual segment. Yield to maturity. Yield to maturity is the total return anticipated on a bond if the bond is held until the end of its lifetime. Yield to maturity is considered a long-term bond yield but is expressed as an annual rate. In other words, it is the internal rate of return of an investment in a bond if the investor holds the bond until maturity and if all payments are made as scheduled. Breaking down YTM. Calculations of yield to maturity assumes that all coupon payments are reinvested at the same rate as the bond current yield and take into account the bond's current price, par value, coupon interest rate, and term to maturity. Yield to maturity is a complex but accurate calculation of a bond return that can help investors compare bonds with different maturities and coupons. Because of the complex means of determining yield to maturity, it is often difficult to calculate a precise YTM value. Instead, one can approximate YTM by using a bond yield table. Because of the price value of a basis point, yield decreases as a bond's price increases and vice versa. For this reason, yield to maturity may only be calculated through trial and error by using a business or financial calculator or by using other software like Investopedia owns yield to maturity calculator. Though yield to maturity represents an annualized rate of return on a bond, coupon payments are often made on a semi-annual basis. So YTM is often calculated on a 6-month basis as well. Yield to maturity is also often known as book yield or redemption yield. Yield to maturity is very similar to current yield, which divides annual cash inflow from holding a bond by market price of that bond. To determine how much money one would make by buying a bond and holding it for 1 year. Yet, unlike current yield, YTM accounts for the present value of a bond's future coupon payment. In other words, it factors in the time value of money, whereas a simple current yield calculation does not. As such, it is often considered a more thorough means of calculating the return from a bond. Because yield to maturity is the interest rate an investor would earn by reinvesting every coupon payment from the bond at a constant interest rate until the bond's maturity date. The present value of all these future cash flows equal the bond's market price. The method for calculating YTM is bond price is equal to cash flow in year 1, 2, so on plus the cash flow of last year, which is divided by 1 plus yield raised to the power 1 2 till power n. Solving the equation by hand requires an understanding of the relationship between a bond price and its yield, as well as of the different types of bond pricing. Bonds can be priced at a discount, at par or at premium. When the bond is priced at par, the bond's interest rate is equal to its coupon rate. A bond priced above par, called a premium bond, has a coupon rate higher than the interest rate, and a bond price below par, called a discount bond, has a coupon rate lower than the interest rate. So, if an investor were calculating YTM on a bond priced below par, he or she would solve the equation by plugging in various annual interest rates that were higher than the coupon rate until finding a bond price close to the price of bond in question. Uses of yield to maturity. Yield to maturity can be quite useful for estimating whether or not buying a bond is a good investment. An investor will often determine a required yield or the return on a bond that will make the bond worthwhile, which may vary from investor to investor. Once an investor has determined the YTM of a bond he or she is considering buying, the investor can compare the YTM with the required yield to determine if the bond is a good buy or not. Yet, yield to maturity has other applications as well. Because YTM is expressed as an annual rate regardless of the bond's term to maturity, it can be used to compare bonds that have different maturities and coupons, since YTM expresses the value of different bonds on the same terms. Variation of yield to maturity. Yield to maturity has a few common variations that are important to know before doing research on the subject. One such variation is yield to call, which assumes that bond will be called, repurchased by issuer before it reaches maturity, and thus has a shorter cash flow period. Another variation is yield to put. Yield to put is similar to YTC except for the fact that the holder of a bond put can choose or sell back the bond with a price fixed and on a particular date. The third variation of YTM is yield to worst. Yield to worst bonds can be called, put or exchange, and YTW bonds generally have the lowest yield out of the YTM and its variant. Limitations of yield to maturity. Like any calculation that attempts to determine whether or not an investment is a good idea, yield to maturity comes with few important limitations that any investor seeking to use it would do well to consider. One limitation of YTM is that YTM calculations usually do not account for taxes that an investor pays on the bond. In this case, YTM is known as the gross redemption yield. YTM calculation also do not account for purchasing or selling cost. Another important limitation of both YTM and current yield is that these calculations are meant as estimates and are not necessarily reliable. Actual returns depend on the price of the bond when it is sold, and bond prices are determined by the market and can fluctuate substantially. Though this limitation generally has a more noticeable effect on current yield because of it for a period of only 1 year, these fluctuations can affect YTM significantly as well. Fisher effect. The Fisher effect is the theory proposed by Irving Fisher determining the interest rate. Fisher proposed two ways of compensating the saver through nominal interest payments. First, the reduced purchasing power of the saver is compensated by the nominal interest payment. Secondly, an additional premium is provided over and above the inflation rate to the saver for foregoing the present consumption. Thus, nominal interest rate is equal to expected inflation rate plus real interest rate. Fisher effect is name given to this relationship between the interest rate and expected inflation. When the expected inflation is subtracted from the nominal interest rate, the real interest rate is derived. The above equation can be rewritten as follows. Thus, the real interest rate would become 0 if the nominal interest rate was equal to the expected inflation, offering no additional premium to the saver for foregoing their present consumption. This would lead to stable purchasing power of the savings, as the savings would accumulate the same rate and that the prices are expected to increase. Factors impacting interest rates. There are three factors having a significant influence on interest rate movements: inflation, number 2, government budget deficit, number 3, foreign interest rate. Changes in equilibrium interest rate. The changes in the equilibrium interest rate can be determined post analyzing the factors causing the shift in demand for money and supply of money respectively, discussed in the following. Shift in demand for money. Two factors comprising of income level and price level causes the shift in demand curve in accordance with the Keynes liquidity preference theory. Income effect. An increase in the income is a reflection of increase in the economy's wealth, promoting people to hold more money as a store of value. Alternatively, higher income can also translate into higher consumption, for which the demand for money balance increases. Hence, it can safely be said that higher income level leads to the outward right shift in the demand curve, indicating the increase in demand for money balance. The increased demand for money owing to rise in income level, ceteris paribus, including no changes in the money supply, will cause demand excess, leading to a rise in equilibrium interest rate. Price level effects. Keynes has given significant importance to the need of people of maintaining the liquidity, holding money balances for short-term use. Thus, when the price of goods and services available in the market increases, the purchasing power of the money decreases. The people are able to buy lesser quantity of goods and services compared to earlier period for the same amount of money. In order to restore their liquidity position that enables them to buy some quantity of goods and services as earlier, their need for money balance increases. Thereby, the inference drawn is that increase in the price level of goods and services leads to higher demand for money, shifting the demand curve to the outwards. That is the right. The equilibrium interest rate shall increase in response to the increase in the demand for money balances arising from the appreciation in the price of the goods and services available in the market. Shift in the supply of money. LTP had already stated its assumption that money supply is controlled by the central bank. However, in the event of increase in money supply effected by the central bank through its monetary, the supply curves shall shift outwards. The market consequently would swell with increased liquidity, leading to the decline in the equilibrium interest rate. Impact of inflation on interest rate. The impact of inflation on nominal interest rate shall be judged from the perspective of both the loanable funds theory and the Fisher effect. Fisher effect suggests higher nominal interest rate that compensates the savers during the period of higher inflationary expectations that can assist saver in maintaining the existing level of their real interest rates. The loanable fund theory also suggests an increase in interest rate but with a different explanation. It proposes that expectation of higher inflation in near future will prompt the household and businesses to increase their investment before the price rises, leading to an increase in demand for the loanable funds with lesser propensity to save. Impact of government budget deficit on interest rates. The impact of the increase in budget deficit of the government will lead to an increase in the demand for the loanable funds at any prevailing interest rate, ceteris paribus. This again will cause an excess demand, causing the slope of DA to shift outwards. With no corresponding increase in the slope of SA, the equilibrium interest rate will increases. However, if increased demand for loanable funds by the government gets transformed into increased savings owing to higher jobs creation by government, then slope of SA might shift outwards. The simultaneous increase in both the aggregate demand and supply of loanable funds riding on the increased budget deficit might not cause the interest rate to rise. The second impact of rising government budget deficit is its causing crowding out effect. The excessive government demand for loanable fund at any prevailing rate from the market having a limited supply of funds will push the interest rate upwards. While increased interest rates would discourage the private sector from borrowing at a higher interest rate, the government would be borrowing heavily, leading to the crowd out effect of private demand of funds. Impact of foreign interest rates. The financial transactions between the countries in this interconnected globalized village increases the vulnerability one country to interest rate movements in other countries. The interest rate differential between two countries will lead to an excess supply of loanable fund in one country offering higher interest rate being diverted from another country offering lower interest rate. Subsequently, the pressure on both the countries will lead their respective interest rate to their equilibrium position over a period of time. International structure of interest rates. International integration between financial markets of the world tends to cause the interest rate movements across countries to positively correlate with each other. However, significant variation in actual interest rate between different countries had been observed at specific time period. Summary. The Fisher effect is the theory proposed by Irving Fisher determining the interest rates. Fisher proposed two ways of compensating the saver through nominal interest payments. The term structure of interest rate is the relationship between interest rates or bond yield and different terms or maturities. The term structure of interest rate is also known as a yield curve and it plays a central role in an economy. YTM is the total return anticipated on a bond if the bond is held till the end of its useful life. International integration between financial markets of the world tends to cause the interest rate movement across countries to positively correlate with each other.